Hi, today we're going to talk about the hierarchy of investment income in retirement. When people retire, they look to their investment dollars to support them for their cash flow needs in those retirement days. While every single individual has a different plan that's required, most retirees fall into a general pattern that we can analyze and make sure that we use the dollars in the appropriate order in order to make them last as long as humanly possible. If we consider that the average retirement age is 65, most people enter retirement with some combination of Canada Pension Plan, old age security, and possibly a private pension for those lucky few. We can analyze this retirement pension income to determine what it provides the individual on a monthly after-tax basis. Our next step would be to compare that to the actual requirements of the retiree to determine what, if any, shortfall is present. Once we have this shortfall, we then look to our non-registered dollars to provide a monthly after-tax flow to bridge this gap. The first place we start is return of capital as an option. This provides the retiree with a monthly flow of income which does not hopefully show up on their personal tax return and allows them to have cash with no current tax bill and quite possibly will manage old age security clawback as a result. If required, we then look at dividends and capital gains as an efficient way to create investment income to provide low-rate taxable cash flow into their hands. As a third spot, we will look at the TFSAs or the tax-free savings accounts. If an individual has done the utmost with these accounts since the government first introduced the program, they will have somewhere between $26,000 and $35,000 in their account. Currently, that amount is not large enough to retire on or use as a pool in this hierarchy. It currently represents an emergency reserve that would cover the repair on the roof or the repairs to the Chevy as required over and above the normal cash flow they receive. In 5 to 10 years, as these TFSAs grow in value, they will in fact move up the hierarchy and will be a fundamental part of the way we all retire. Lastly, we look at corporate assets. These are assets held on an after-tax basis in a Canadian-controlled private corporation. These are last on the list because they will automatically have a tax liability attached to them when we withdraw the money from the corporation. Finally, we look at RSPs or registered accounts. If possible, we would like to defer the use of these accounts till age 72 when the government mandates that we must withdraw a minimum. We do this because this money is growing tax deferred inside these accounts. They also require these minimum payouts, which will impact our personal tax returns and as a result may accelerate OAS clawback. But we cannot forget about the annual $2,000 pension tax credit that's available on everyone's personal tax return. This is a use it or lose it tax credit, and Canada Pension Plan and Old Age Security do not qualify as qualified pension for this credit. It must either be a pension income from a private source or our own RIF payouts. It cannot be an RSP redemption, but must be a RIF payout in order to qualify for this credit. If a couple each access $2,000 of this credit, that's $4,000 of extra tax-free retirement money for them and may well mean the difference between that extra week or not in Florida or Arizona each year. But as a general tip, each taxpayer should annually review their RSPs to determine if there is any ability this year to withdraw money from our RSPs at a lower average tax rate as a cost than we got as a tax deduction when we made the contribution. This will allow us to turn RSP money into non-registered money, which is more flexible to be used in retirement, and will minimize the amounts we must take out at age 72, which may well, if we do not control it properly, negate our ability to maintain the old age security and not be clawed back for the rest of our retirement years. So how can NexGen Financial help with this hierarchy of retirement income needs? Once an individual determines how and when they want to use their dollars in retirement, NexGen's patent-pending corporate class structure will provide them with efficient access to the right type of investment income or not, as in order to implement the plan. For example, a stream of return of capital, eligible Canadian dividends, or capital gains can be pre-selected as your preference in order to implement your plan for the upcoming year. Hopefully that helped you understand the hierarchy of retirement income, and we'll see you the next time on Tax Alpha.